Thank you, and welcome everyone. My name is Joe Loparco, and I'm with the ING U.S. communications team, and we're happy that you're joining us today. We've all been hearing how retirement has fundamentally been changed. Individuals are shouldering more responsibility than ever before for their retirement readiness. A growing part of this challenge is finding effective planning and investment strategies that can help create a reliable stream of income in retirement. And that brings us to the theme of today's briefing, how the retirement income landscape is being redefined. Our goal today is to provide you with some insights and trends that we at ING U.S. are seeing in three different areas. First, the annuity market. Second, the financial advisor space. And third, with retirement savings plans at the workplace. All three represent important aspects of our business at ING, as well as opportunities to help consumers better prepare for their eventual retirement security. Now, before we begin, I'd like to share some of the latest findings from our ING Retirement Research Institute. Much of our research is focused on studying the emotional and psychological factors that affect planning and saving for retirement. Now, if you look at the slide that's up, according to an online poll that we recently conducted in June, nearly 2/3 of those that we questioned agreed that they would need $1 million or more in order to have a comfortable income in retirement. Meanwhile, a sizable amount, more than 1/3, believed that they'd be able to get along comfortably with $500,000 or less, or else they didn't know how much. In a separate phone-based survey that we also conducted last month, 1/3 of retirees that were polled confirmed that they're experiencing a lower standard of living in their retirement years. Now, at the same time, only 8% of pre-retirees that we asked expect that this will be a reality for them. We think these findings are pretty telling, and they demonstrate possible gaps between the perceptions and the realities that many people will have with their own retirement security. Now, I'd like to turn to today's agenda. Our briefing today will include presentations from three of our business leaders here at ING U.S. within our retirement solutions business. First, Dave Bedard, who's president of our ongoing annuities business, will discuss the evolution taking place in the annuity space, and he'll focus specifically on the growth of fixed index solutions. Next, we'll have Rich Linton, president of our individual markets business, discussing the best practices that financial advisors must adopt in order to meet the evolving needs of their clients. And this includes holistic planning that addresses retirement income. And then finally, Rick Mason, president of our corporate markets business, will explain how employers are evolving their benefit offerings and why retirement income options inside a workplace savings plan are gaining traction and interest in the market. Each will spend about 15 minutes on their topic, and then we'll leave a few minutes at the end for any questions that you may have. These three perspectives on the retirement income challenge, coming together in one forum like this, we think demonstrates how pervasive the topic is, and we hope you find the information today useful and meaningful. So with that said, I'd like to turn it over to Dave Bedard.
Thank you, Joe, and thank you all for joining us today. Let me start by making a statement we all know well and continue to hear and read about all the time. That is, the need for Americans to prepare for retirement has never been more critical. As a result, the need and urgency for retirement planning and retirement solutions will continue to increase. Now, a key component for secure retirement is creating a guaranteed income stream, or ideally multiple income streams in retirement. Put quite simply, how do people replace their paychecks once they retire? This really is the core of the retirement question. With that said, my remarks will focus on the annuity landscape and the increasing role fixed annuities, and in particular indexed annuities, are playing in the retirement income discussion. Now, I'm sure many of you probably already know that one can generate retirement income through a number of different investment options and strategies, ranging from diversified bond portfolios, dividends from stocks, target date and target payout funds, CDs, income from rental properties, and even just living off of simple interest. However, these solutions do not provide a guarantee. It's this guarantee element why annuities are such an important part of the retirement planning process. The annuity market is unquestionably being redefined. I don't think anyone would dispute that fact. We've all been hearing a lot about the lack of general preparedness and underfunding that most Americans are facing within their retirement. With the lingering effects of the recent economic crisis still very top of mind, people are seeking stability. As a result of all of these factors, the current environment requires new solutions and ongoing creative thinking. One area where this is evident is the increasing demand for fixed indexed annuities. So you may ask me, Dave, what's the appeal of a fixed indexed annuity? In response to that, my answer would be that an indexed annuity is a fixed product which also allows consumers to participate in the equity markets when the markets perform well, but also provides protection in the event of a market downturn. This combination of features has become quite attractive to consumers. Looking at slide 5 here, you can see the increasing popularity of fixed index products over the past 10 years. If you look at the chart on the right, the bar chart, you can see that sales were $34 billion in 2012, almost 2.5 times the level that was seen in 2003, and they've been growing at a 10% annual rate over that time period. Fixed index annuities have jumped from 6% of total annuity industry sales to about 15% of all sales over the past 10 years. Another proof point of their growing popularity and demand is if you look at new product launches. In 2009, there were 24 products launched in the industry. That number grew to 49 last year, and 2013 is on track to be even higher, and we believe these trends will continue. Now, before we look at the reasons for this growth, let me take a step back and look at the big picture surrounding fixed annuities. Slide 6 here, I actually find to be quite interesting, as I think it highlights that annuities have played a significant role in people's financial lives for many years. The idea of paying out a stream of income to an individual or family has been documented back to the Roman Empire. Now, I'm not sure I can unequivocally prove that point, so I'm going to ask this crowd to just go along with that, go along with me on this one. But they go back a long time. The first fixed annuity was offered in the United States over 250 years ago, which predates and goes back even prior to the Revolutionary War. Indexed annuities began to appear on the scene in the mid-1990s. Through the late 90s, they increased modestly, with increases of about $1 billion in sales each year. Then, in the mid-2000s, fixed index annuities with lifetime income withdrawal riders started to become popular as the need for guaranteed income began to be better understood given the decline in pension plans and the increasing concerns about Social Security being the main source of retirement funds. Today, election rates for these riders are in excess of 60% in the industry. As a result, the conversation has shifted to focus not just on saving for retirement, but also on ways for retirees to generate an income stream that they can't outlive. As a result, providers like ourselves and others are looking at new and innovative ways to help customers. The next wave of growth and innovation in this space is leading to new hybrid strategies and longevity income features. We're starting to see different products getting bundled together, in particular to help with healthcare concerns. And with many retirees living in fear of outliving their retirement savings, innovations are currently underway to help with securing guaranteed income during the latter stages of retirement years. Here at ING U.S., we've responded to this growing market need with our own lifetime income solution, which we just launched earlier this year. One key feature of the product is that retirees can grow their income by waiting to start taking withdrawals. Another critically important feature is around flexibility. If a retiree needs the funds, say to buy a second home, fund a grandchild's education, or help with medical bills, they have access to their original premium after any withdrawals they may have taken. This is helpful because it can help overcome the reluctance of many people to lock up their money for long periods of time in this low interest rate environment. This focus on growth, flexibility, and innovation is what makes the direction of the industry very dynamic right now and equally appealing to consumers. Looking at the broader annuity landscape offers some more insight into this trend. Looking at this next slide, you'll see that there are 3 main categories of annuities: variable, traditional fixed, and fixed indexed. and they're designed to accomplish different things. Each offers value. In the end, what matters to a consumer is really measuring their retirement needs balanced against how much risk they're willing to take on. Now, I suspect there are varying degrees of understanding of these products, and I promise here I'm not going to walk you through each of these in detail, but this slide offers a simplified overview of some of the key features between the products, and I'd be happy to try and take any questions you may have at the end of this call. Starting with variable, variable arguably has been the most popular annuity product over the past decade, and it allows people to invest in the equity markets. However, they also introduce the greatest volatility to both customers and providers, as we've experienced so recently. On the other end of the spectrum, traditional fixed annuities generally represent the least amount of risk. However, in this prolonged and historically low interest rate environment, rates have been a real challenge. Falling right in the middle is the indexed annuity. These offer fixed rates with the potential for some upside based upon the performance of a market index, for example, the S&P 500. As the chart highlights, the fixed indexed annuity is really in the sweet spot from a feature perspective, including many of the features of both the variable and the fixed product landscape. Given increasing lifespans, retirees now need to grow their money over what can potentially be a 30-year time horizon. This blend of growth and guaranteed security found in index products is becoming an increasingly attractive feature. So why are we talking to you about fixed index annuities today? Well, it's pretty simple. It's really because this is where we see the industry moving right now. These next charts show that indexed products are the only product where sales have increased over the past 5 years, growing at an average rate of 5% a year, as you can see at the top of this slide. Conversely, variable annuities and SPIAs have remained essentially flat over that same time period. Traditional fixed have declined almost 18% due to the interest rate challenges I just mentioned. And because of that, people are reluctant to tie up their money in lower yielding traditional fixed annuity products in this historically low interest rate environment. In just the last year, from 2011 to 2012, VA sales declined 7%, falling from $158 billion to $147 billion, as you can see at the bottom of the slide, while indexed continued to grow, increasing 6% to $34 billion. We foresee this trend continuing. As I've said, the annuity landscape is quite different today than it was just a few years ago. The recent environment has really impacted investors' psyche and their overall risk tolerance levels. People today are more conservative in their investments. We've also seen changes in the landscape as providers, including companies like ourselves here at ING U.S., who scaled back or exited the variable annuity marketplace, further contributing to overall declining variable annuity sales. Again, indexed annuities provide a good blend and compromise, coupling safety with the stability and along with upside potential should the markets perform. This is what has led to the steady growth in the marketplace, which we believe will continue going forward. So in closing, I see 3 trends that illustrate how the new normal for retirement is changing the annuity landscape. First, the focus on retirement income is here to stay. It is not going away, and the need for new guaranteed income solutions will only accelerate. Second, index annuities, which provide both growth potential and downside protection, are proliferating at a healthy clip, and this will continue. And third, this environment is driving changes in product design and income and protection features. We will see innovation in new longevity income vehicles and hybrid strategies continuing to emerge. Now, as I've said, we've already seen innovation and bundling of different products, particularly in the healthcare. We're designed to try and help people with some of their healthcare concerns. So, products that combine annuity and long-term care combinations. Others where you'll take an annuity feature and couple it with a critical illness feature. So we've seen that evolve over the past 7 or 8 years or so. I believe we're going to see this even more on a go-forward basis as providers look for ways to help retirees deal with the significant cost of healthcare and retirement. I would also say that there's plenty of room for additional innovation, including legacy planning, charitable giving, travel and leisure, and other key issues and needs of retirees. And another area which I think is ripe for innovation maybe helping what I'll call the so-called sandwich generation. Those folks caring for older parents while also raising young children. These innovations could include or combine, for example, elder care for aging parents, retirement planning for boomers, and educational funding, all wrapped up in one product solution. So these are exciting times in our market, and I believe they'll become even more exciting as we go forward here. So with that, I'm going to hand the presentation over to Rich Linton, who will look at retirement income through the lens of the financial advisor.
Great, thanks, Dave. Good afternoon, everybody. When we think about all the changes and decisions a person has to juggle when they contemplate retirement, and I'm not just talking about their financial decisions, this can easily be a time of great stress in people's lives. I mean, don't get me wrong, the change is good and welcome, and we all hope to get to that point at some time. But without some help, a retiree's plan could easily be thrown off course. Advisors can truly help to reduce this stress. Along these lines, I'd like to shift our focus now to how we can better help people plan for retirement, which includes addressing retirement income, and how the best financial advisors are shifting their thinking. So let's start with some research findings from the ING Retirement Research Institute. As Joe mentioned earlier, our research focus is to understand people's behaviors and mindsets about retirement. In a recent study, we found that working with a financial advisor greatly increases the odds that a person has calculated what their retirement savings will translate to as a stream of income. If we look at slide 11 on the left and in the bar chart, it reflects that 87% of those who work with an advisor have calculated what their retirement savings will provide in a monthly income stream. A fairly solid 59% who are not working with an advisor still have calculated that number, but clearly there's an inertia factor there with not being able to get that up to 100%. One of the greatest obstacles to adequate financial planning has always been human inertia. We've seen this time and time again in our research. People don't act for a number of reasons. Financial planning is complicated, it's not an immediate need for me today, or it's frankly not interesting to an individual, and so they put it off. An advisor's value starts, and I think there's a key point, an advisor's value starts with helping people get past inertia and framing the effort in such a way that people are engaged in their future. In making the future real and tangible today, advisors can help investors paint a picture of what retirement will look like, and if they don't like that picture, what they can do today to achieve a better tomorrow. I think that's a critical responsibility for advisors. So speaking about better tomorrows, another compelling study, and this is on slide 12, sponsored by our ING Retirement Research Institute, underscores that people are willing to make good forward-looking decisions regarding their financial situation when they're presented with well-framed trade-offs. So according to our research, consumers overwhelmingly acknowledge that they're willing to give up spending today for their future. 80%, if you look at the left-hand side, 80% would make this financial trade-off as the chart reflects. This clearly speaks to the value of framing choices versus relying on abstract visions of the future. So conceptually, most people are aware of the benefits of this trade-off. Yet as we can see on the right-hand side, more than 1/3 believe that they'll still run out of retirement savings. This isn't surprising, but it speaks to the value of framing choices. The next slide will show us just how many people will need to be presented with these choices in the very near future. So there's a demographic change in our country that's impacting all aspects of society. This graying of America affects the employment landscape, the healthcare system, social security, and of course retirement. Now, this trend is not new to any of us here on this call, but we need to pay close attention to the size and scale of the change, as shown on slide 13. If you simply look at the increasing percentages of people that will, from 2000 to 2025, that will be in what we traditionally call the pre-retiree age group of 55 to 64, and the retiree age group of 65 plus, you're looking at 70% growth in the pre-retirees in 25 years and an 81% growth in retirees. When you combine those aging projections with the accompanying increases in investable assets that are noted on the bottom of the page, the ultimate question we have to ask is, how can these boomers best be helped? advisors are clearly going to have to expand their business models and expand their view from an accumulation-centric to a life-centric approach. Holistic planning across a range of goals and needs is going to be crucial, and planning will be more complex as advisors are serving an aging client base. If we look at some of our top advisors, there are certain advisor best practices that professionals can implement to help answer the key questions that really drive good retirement income planning. How much will healthcare cost? When should clients start taking Social Security? What's my optimal retirement age? How much do I need in monthly income to feel and to be secure? Having answers to these common pre-retiree questions can help set advisors apart, and this has helped us frame our Retirement Readiness Practice Management Program, developed for advisors of the ING Financial Partners Network. At the foundation is a set of beliefs that drives this program and our strategy for supporting investors. Individuals, regardless of wealth or income level, should have the benefit of a financial planning experience. Those over age 50 should complete a retirement income analysis so that they can understand what their retirement paycheck will look like. And 3, retirement savings is not one goal, but 3. It's about understanding your needs, your wants, and your wishes. So if we flip to slide 14, we'll go through the elements of the practice management program. As I mentioned just a moment ago, first, organize the retirement savings discussion around 3 goals. Most people perform this mental sub-accounting in their own head, so let's frame things the way they're thinking about them already. From a needs standpoint, this is the income required to ensure basic necessities are met, safety and security, and to be able to withstand a household shock. We can't anticipate every situation that'll come up in retirement, so our needs-based planning should include the potential or possibility of a household shock. Second, there's the wants, aspirational goals that define an individual's lifestyle in retirement. What do we want? What's our vision of our retirement? How do we want to experience retirement? What are our goals there, and how do we plan for that? And then third, wishes, the ability to leave a legacy. No matter how big or how small, individuals have people and causes they care about, and it's important to factor in what they might want to leave to those people and or those causes. It's important advisors fully understand clients through this lens, through these 3 frames of needs, wants, and wishes. Each goal carries a different degree of importance and risk tolerance. Second, repeatable process that draws a client into the conversation. You've got to make the conversation personal so that the client is engaged. You've got to paint a picture of what retirement will look like, what their retirement experience will be. You've got to review all of their options, and you've got to revisit that periodically. Third key element is to ensure you're life stage focused. Very different mind states depending on what life stage your client's in. Early accumulators, they may have college debt challenges, and they might not be able to see or focus on retirement until you've met their more basic and immediate need. Mid-range accumulators, they may have upcoming tuition for their children, and again, they may need to be focused on that before they can really focus on their retirement, so you need to help them with their multiple goals. 3, pre-retirees are often protection focused, and retirees are focused on that steady paycheck. So you need to understand and work within the bounds of the life stage that your client is operating in today. Fourth key element is you need to have the tools and resources to analyze a client's situation all in one place. A client needs to be able to see their financial life through a clear, simple lens to understand what they have and how that will serve them in retirement. And finally, nothing's as important as just good old-fashioned education and dialogue on the key factors impacting retirement income. Their lifestyle, how they budget, healthcare needs, investment risk tolerance, their income sources. Many people, especially as they age, increase the number of income sources that they may have access to in retirement. And then, as David said earlier, multi-generational needs. Might they be caring for parents in retirement? Might they have children living with them in retirement? What are the multi-generational situations that they all have? Life offers a tremendous amount of uncertainty. Behavioral finance tells us that people want safety, they want security. Applying a disciplined approach can help create certainty in one little corner of a client's retired life. In closing, and on our last slide, the 3 keys for advisor success in a graying America. Again, they have to increase their skill set. Successful advisors of the future must have a broad skill set that's able to help their clients with growth, asset protection, and income security. 2, advisors need to view the world through the client lens, their needs, their aspirations, their potential household shocks, to develop that comprehensive, holistic plan. And 3, and aging demographics create more complex financial planning scenarios. The process is crucial. 1, so that you can ensure that you are comprehensive with your client, but 2, so that as you engage in these much more time-intensive engagements with your clients, that you have the capacity to manage all of your clients in this way. So good, solid, consistent, repeatable process is critical. Retirement income is not simply a retail wealth management focus. It's a growing focus for plan sponsors as well. I'd like to turn the program over now to Rick Mason to discuss that further.
Thanks, Rich. Let's shift our focus now to how the workplace has been responding with the emergence of in-plan retirement income solutions. You know, from a sponsor's perspective, an employer's perspective, the interest in these options continues to increase. As you can see from the slide, approximately 12% of employers offer an income solution as part of their fund lineup currently, and that number is expected to more than double in the next year. You know, it's a clear indication that sponsors are recognizing the benefits of these solutions and can have on ensuring that the workforce is retirement ready. The growth has largely been driven by the small employer, the small end of the market, where advisors who are supporting these plans can help articulate the benefits and review the details in these solutions. But it's not just found as a small market trend. The large end of the market, the interest is high and is really showing up in a lot of the requests for information from consultants and requests for information by large Fortune 500 sponsors. The solutions are more customized and adoption is a bit slower, and we would expect not to see a real shift for a number of years at the large end, but the interest is high across the board. So what does this all mean for 401k plan participants? It means there's an actual increase in focus on helping individuals connect their savings to income. As you can see on the slide, historically the industry has focused on the accumulation phase. You know, the 401k plan is only 35 years old, and it began as a supplemental source for simply saving, and now it's the cornerstone of retirement for most working Americans. But as important as these plans have become, the concept of simply saving into a plan is not the complete answer. Plan offerings, they need to continue to evolve and adapt, and the industry must evolve and adapt too. You know, as we broaden the dialogue to not just how much we're saving, we really have to think about defining not the contribution of what we're putting into the plan. We have to define the outcome. What should we expect from our 401k plan? And as Rich pointed out, there's a behavioral finance perspective, and it can really be a challenge. You know, many people, most of us, we like to put off to tomorrow what we can do today. I know, you know, I like to eat ice cream today. I will exercise tomorrow. And, you know, we have to change that behavior, and we need to make people think and take care and take action, you know, 20, 30, 40 years before retirement is a tangible reality, which is a challenge for us all. We have to think about building up savings along the way and give ourselves time to get there and translate what does it mean when I stop working? What will that paycheck or income stream look like? And one way we started to do this in the 401k space during the accumulation phase is through the introduction of auto features and in the accumulation phase, whether it's target date funds or auto escalation, auto enroll. We need to take some of these best practices during the accumulation phase and translate them into the outcome phase. On the next slide, you know, it shows the three key features of in-plan income options. You know, first, it needs to be easy and automatic. You have to start early enough, and our research shows that over half of the survey respondents like the idea of being able to access income while they're still saving. Just because people like the idea doesn't necessarily mean they'll act on it, though. And I know I want to exercise regularly, though I still like to eat ice cream. And in order to get on the treadmill, I have to figure out ways to get the hurdles out of the way. And when we think about this in terms of income, to get people to change their behavior toward retirement today, we really have to think about those auto features make it easy and automatic, and something that leverages a known feature like a target date fund where it's automatic. If we think about, other aspects of a retirement savings, whether it's our home, that's largely, any equity we have in our home, that's been largely automatic because we're paying our mortgage regularly, and even the amount we have in our 401k plan, it's because it's coming out of our paycheck. So it does need to be easy and automatic first and foremost. Secondly, we need to let participants have flexibility and control. And Dave mentioned this earlier when he suggested that the evolution of fixed index annuities, investors were looking for options that were designed to be flexible in the event they needed to withdraw funds for unforeseen circumstances. The same thing occurs within the 401k plan. In fact, even saving in a 401k plan in the first place, there was the introduction of a loan feature for that very purpose. And so that emotional hurdle to be able to save and not feel that you're emotionally locked into a solution needs to be addressed. In fact, 83% of respondents in recent research suggested that they wanted to keep the money around in case of emergency as their number one reason. So it's exactly the point Dave had made earlier. And having the flexibility to withdraw funds, though, for simple flexibility for emergency is only one part of the story. We're all, in today's society, we're no longer working from cradle to grave for a single employer. The workforce is very mobile, and so even having the ability to address our needs for retirement income between employers is important, and that needs to be addressed as well. So flexibility and control is point number 2. Point number 3, and this brings us to the key feature, is that it needs to address the risk we actually face in retirement, and those two risks are the market risk and longevity risk. It's not surprising at all that over 3/4 of the plan participants are concerned about their financial security once they leave the workforce. By investing in an in-plan income option, participants are automatically building critical retirement savings, followed by a guaranteed income benefit for life. And what's more, investors, they don't want to experience bad market returns close to or early in retirement, as many did in 2001 and recently in 2008. So you save you work your whole lifetime, you save, and then the market is down just when you're getting ready to retire. And so you either need to live on less or work longer. So these in-plan options need to be able to address market risk, protecting against the market going down, and then also making sure you don't outlive your actual assets. So let's take a look now at the next slide and how an in-plan option practically would work and how it's set up to work. And while there's a number of solutions available in the marketplace, and I can't speak to the design of each, we'll use the ING's own lifetime income protection program as an example. When we did our research and we were designing our program, we were mindful of some of these emotional hurdles we heard from sponsors and participants, and our program was designed to address them. Participants in our program are placed in target date asset allocation models or portfolios based on their age. So again, easy and automatic. And over time, each portfolio has a glide path where participants are automatically allocated between target date funds and a guaranteed fund. And beginning mid-career, this glide path begins to periodically allocate an increasing portion of assets to the guaranteed fund until 5 years before the portfolio's target date. 100% of the assets are guaranteed. So, taking advantage of the concept of dollar cost averaging. Over time, you're buying retirement income, and it's happening automatically in a way that is appropriate and personalized for you based on a target date fund. And then, in retirement, the investor can start collecting that guaranteed income and can elect single or joint coverage. And the good news is, along the way, the investor is able to withdraw money from the program at any time for unforeseen circumstances. So again, that flexibility and control. And there's a potential each year for the investor to realize growth in the guaranteed fund if the markets perform well. Again, something Dave mentioned earlier. So if the markets are up, I want downside protection, but I do want the ability to share in the upside. So it's really designed to hit those main key elements. So where does all this leave us at the end of the day? There's really there are 3 key trends or takeaways I'd have you think about in the workplace. One, there's going to be an increased role for employers. Employers are going to be increasingly involved in advancing retirement readiness in their workforce. Not just because employees are asking for it, but employers are increasingly being looked at by policymakers to play a greater role. But employers also stand to benefit. I mean, so not only is it a public policy issue, not only employees need it, but quite frankly, it's an economic issue for employers as well. If employees aren't ready to retire, it can drive up employer costs, employer benefit costs. Longer tenured or higher paid employees who want to retire may have to delay their retirement for financial reasons, which would also stop the advancement of younger talent into increasing roles. And so it could be a workforce talent management issue as well. So employers see this and are focused, and why we're seeing so much interest around these topics recently. Second, employees will increasingly ask for personalized solutions to address how their savings will translate into income. And public policy continues to drive this change, for more employee involvement in the future. And many of us in the industry, including ING, we're ahead of this concept that recently arose in the DOL Lifetime Income Disclosure Act, which would require retirement plan providers to include income illustrations on existing participant statements, and that'll no doubt generate questions from employees. So taking the number that's on your statement and translating it into a monthly income, so you can get a sense, because we all think about, we don't think about our retirement in terms of a big number. We think about it in our monthly expenses and our monthly revenue and our monthly paychecks and income. And so we've been doing that for quite some time, and increasingly as Americans see this number, it's going to generate more questions, and it will be, and quite frankly, employees will request more personalization of their information. And then third, advisors and consultants that specialize in the 401k market will be increasingly interested in retirement income and in driving innovation within the industry to develop solutions that are that are institutionally designed to address retirement income. Now, with that said, I'll hand it back over to Joe, who will open up the lines for any questions.
Thanks, Rick, and also thanks, Rich and Dave. We just heard three separate but I think very interrelated views on this topic, and some common themes that were kind of woven throughout that are getting more and more attention in the industry. So I would like to open it up for questions. Before we do that, though, I want to point out that if you are so inclined and want to follow up with us separately, you can reach out to anyone on our communications team about this topic today, or if you have any future needs on topics down the road.